Here we are. Thanks for coming back. Hope everybody is doing well. How was the homework? Not too bad? Okay, let's dive right into it, okay? Because there's some other things I want to talk about today. Actually, the lecture we did before this one said partnership's conclusion. This one probably is the partnership conclusion because we still have to go over that Chapter 12 homework. But once we go over the Chapter 12 homework, we're done except for the Chapter 12 Connect assignment, which after this class period, I will put out there and you can do. I'll talk to you folks about your due date off camera so it doesn't mess up the online folks. For you online folks, always be checking the calendar on the D2L website for your due dates on tests and the Connect assignments. So let's go ahead and dive into the homework. All right, I think 12.5 was the first one. Is that correct? So let's go right to that. All right. 12.5. Okay. Kramer and Knox began a partnership by investing $60,000 and $80,000 respectively. During its first year, the partnership earned $160,000. Prepare calculations showing how the $160,000 income should be allocated to the partners under each of the following three separate plans for sharing income and loss. Okay? First of all, what if the partners fail to agree on a method? How will we then do it? We'll do it equally, right? So how much was the net income?
160,000.
160,000. So that would be equal, right? 160,000 or 80,000 each, correct? All right. And number two, what if the partners agreed to share income and loss in proportion to their initial investments? Round amounts to the nearest dollar. Okay, well, we did a little allocation here. They write it out a little differently than I would have, but they recognized that Kramer had capital of $60,000. Knox had capital of $80,000. That's a total of $140,000, right? So for Kramer, you take 60 divided by the total of 140 times that net income of 160,000. And you get 68571. If you're within $1 or $2, that's fine. Okay? Then you do the same thing for Knox. You take, they had 80,000 capital. You divide it by the 140,000, take it times the net income, and you get 91,429. Right? Again, you can round, but you want to make sure that those numbers add up to 160,000 or your journal entry is not going to balance when you book it. Correct?
So on mine, instead of using the full decimal, I used the very first decimal, so I was like $150 off, but it's still equal.
You're 150 bucks off?
I got 91,200 and 68,800.
That's what I got.
Yeah, I did the same thing, just rounded the percentage rather than divided
Oh, you
out.
did?
Yeah.
Okay, well, try to take it to at least I would probably give you cleaner numbers, but off by a couple $100. If I was a partner, I might go, hey, a couple $100 is important to me. So take it to at least a couple decimal places if you can. Sometimes I think it's easy as opposed to taking 60 divided by 140 and taking the, that number and then rounding. Just 60 divided by 140 times 160,000 in your calculator. Okay? Just punch it in that way. And again, make sure it adds up to the net income. Okay? But look, sounds like you have a general understanding of how you're doing it. So, okay, number three, what if the partners agreed to share income by granting a $50,000 salary allowance to Kramer, a $40,000 per year salary allowance to Knox, 10% interest on their initial capital investments, and the remaining balance shared equally? Okay, we've done these. We have a net income of $160,000. We have salary allowances of $50,000 and $40,000, respectively, for Kramer and Knox. Then we have interest allowances of, did you get $6,000 and $8,000 for their interest allowances? Okay, good. Now, what do those four numbers add up to? 104,000.
104.
Is that right?
Mm-hmm.
Okay. We take that 104,000 subtracted from 160,000, and we get 56,000. How do we divide that balance?
Equally.
Equally. So half of 56,000 is 28,000. Thank you. Half of 56,000 is 28,000. And we add those three numbers up and we get 84 and 76. Now here's the key thing. Does that number plus that number equal the net income of 160,000? Yes, it does. Okay? Let's take a look. They don't ask for this, but let's go ahead and look to see what that journal entry would look like to book that. Okay? It would look like this. All right? We would debit income summary to close out that net income, and we would credit Kramer capital for 84 grand, Knox capital for 76 grand. You with me? Okie doke. Now we're going to go to 12.6, which is kind of a continuation on of this one, right? The only thing they're going to do is change the net income amount. Is that correct? So let's go ahead and take a look at that. I'm just going to put the whole solution up there for part one. Okay. Part one, the net income is now 98.8. Now, everything in this circle stays the same. That still equals 104,000. 98.8 minus 104,000 equals negative 5,200. What's half of negative 5,200? Negative 2,600, right? Add those three numbers up. Add those three numbers up. You get 53.4, 45.4. Does that plus that equal that? Yes, it does. Okay. And they didn't ask you for it, but the journal entry would be this one right here. Okay. This one right here, where we would debit income summary for 98.8, credit their two capital accounts for the amounts that we got from the analysis. You with me? Okay. All right, let's do the last one. The last one says we have a net loss of 16,800. A net loss of 16,800. Now, I think it's actually kind of more beneficial to think of it as a negative net income in this analysis, okay? So let's take a look. Well, we should probably put those titles up there again. That's Kramer. This is Knox, okay? We have a negative net income, 16,800. Everything in the circle stays the same. That still adds up to 104,000. 16.8 to the negative minus 104 equals 120,800 to the negative. What's half of that? 60,400 to the negative. Add those three numbers up, and that's what you get. Okay? You actually get negative 4,400 for Kramer and negative 12,400 for Knox. Okay? Now, any questions on that?
Is it all right that we switch the interest? Well, I switched the interest allowances. Like, I had Kramer having an 8,000 interest allowance for every problem. I did that.
Well, that's not right, because Kramer that's not 10% of his capital balance, is it?
Well, it doesn't say which one. In the problem, it just says one puts in this much and one puts in this much. It doesn't say which one puts in which.
Okay, that's a good question. What they say is Kramer and Knox began a partnership by investing 60,000 and 80,000, and then they say respectively. Respectively means that order. Kramer and Knox, 60,000 for Kramer, 80,000 for Knox. Does that make sense?
Yeah.
Good question. So they do that a lot. So that word respectively, that just means in that order that we just said. Cool? Good question. Okay, here's a good question. Speaking of good questions, how would the journal entry look to book this situation down here?
Capital and credit income summary.
That's correct. You would have to, because here we're going to actually decrease the capital balances of those partners, correct? We know that capital is a credit balance account. That means you increase it with a credit and you decrease it with a debit. So since those amounts up here are negative, here would be the journal entry to book that. Okay? We would debit capital Kramer for 4,400, debit capital Knox for $12,400, and we would actually, did I say that right? We're going to debit those two capital accounts, and we're going to credit income summary. There's never a negative sign in a journal entry, right? Don't ever put a negative sign, okay? So, all right, any questions on that, folks? Anybody? If not, let's take a look at 12.9. The partners in the biz partnership have agreed that Mandy may sell her $100,000 equity in the partnership to Brittany, for which Brittany will pay Mandy $85,000. Present the partner's journal entry to record the sale of Mandy's interest to Brittany on September the 30th. All right, we can do that. This is that kind of simple situation when the exchange of cash actually occurs outside of the partnership business entity. So we do not have the number 85,000 anywhere in our records, the cash that was exchanged. What we simply do, looking at this journal entry, is we are decreasing capital for Mandy by the 100,000 and increasing capital for Brittany by that 100,000. You with me? Okay. All right. Questions on that one, folks? All right, then. Well, let's go ahead. We have 12.7, but what I was wanting to do, I'm looking in all my piles up here for my work. We need to go over the, didn't we have a bonus question that we had not yet covered? Okay, so let's go over that one. Go ahead and get that work out. And let me see if I can find where I put it. Here it is. You guys can quit looking. I found it. Okay? All right. What we had here, let's refresh our memory a little bit. In here, this is the admission of new partner handout. Okay? The admission of new partner handout. Okay? But what we had up here in Part B was prepare the journal entry to record the journal entry for the admission of Lado, which is the new partner, assuming he invests cash of $90,000 into the partnership. And what we did was, looking at the information at the top of example 2, we recognized that the equity before the new partner came on board, it was a total of $200,000, correct? This is all stuff we did last time. We're not to the bonus question yet. The cash invested by the new partner is going to be $90,000. That will give a total equity of $290,000 because that cash infusion, that addition in assets is going to increase total equity. What's the partnership interest that they're going to give Lado? 30%. What's 30% of $290,000? $87,000. So the way that we did this journal entry up here in plan Part B was we debited cash for $90,000 and we credited capital for Lido for $87,000. That was the first thing we did. That journal entry didn't balance, did it? The credit needed a total of $3,000 to make that JE balance. Well, in Part B, before we got to the bonus question, they share that equally, right? So we credited capital for Hulse for $1,500 and we credited capital for Morris by $1,500. Are you with me? Okay, now in the bonus question, everything is the same except that bonus attributed or paid to the old partners is not shared equally, but rather in a ratio of 20% to Hulse, 80% to Morris. So this analysis still holds. $200,000 equity before the new partner, cash invested by Lido of $90,000. That'll give us total equity of $290,000. Lido is still having a percent ownership of 30%. Thus, Lido's capital balance will be credited for $87,000. Is that correct? Okay. So let's go ahead and do this journal entry. How much is cash going to be debited for?
90.
And how much is capital for the new partner, Lado, going to be credited for? $87,000. Does that JE balance? It does not balance, does it? Okay. Well, this needs $3,000 on the credit side to balance. So we are going to divide that up. Capital, Holst, capital, Morris, but we're not going to divide it up equally. We're going to divide up 20%, 80% for Holst and Morris respectively. Okay? What's 20% of 3,000?
600.
What's 80% of 3,000?
2,400.
2,400. Cool? All right. Questions on that? You kind of go through the same methodology though, right? The same process, correct? Okay, now let's do 12.7. All right? 12.7. All right? 12.7, right here. The Struder Partnership has total partners' equity of $510,000, which is made up of Main Capital $400,000 and Frist Capital $110,000. The partners share net income and loss in a ratio of 80% to Main and 20% to Frist. This is very similar to the bonus question, isn't it? On November 1st, Madison is admitted to the partnership and given a 15% interest in equity and a 15% share in any income and loss. Prepare the JE to record the admission of Madison under each of the following separate assumptions. Okay. Madison invests cash of $90,000. Okay. Well, let's go ahead and do this. All right. What is the total equity before the new partner? What is it?
510,000.
A total of 110.
No, 500.
510. Thank you. What is, in the first situation, we have cash invested of how much? 90,000. So the total cash invested by the new partner. So the total equity after that will be 600,000. Is that correct? And then what is the percent ownership they're going to give? 15?
15.
The new partner, and I think that's Madison, right?
Yep.
Interest will be 15%. What's 15% of 600,000? 90,000. You're correct. Okay. So, how do we go about doing this? Well, let's take a look. If I can find my answer. All right. Well, in this case, looking back at this, cash invested is 90,000, and let me go ahead and label this. The capital balance of Madison, the new partner, will be 90,000, right? So the journal entry that we have is going to be, I've got too much stuff up here, okay? I need a table, all right? It's going to be this right here. We debit cash for 90,000, credit Madison Capital for 90,000. Do you agree?
Yes.
Okay. That one's pretty easy. Let's go to the next one. What if the cash invested is not 90,000, but is rather, how much? 120,000? Okay. Well, in that case, the total equity is still 510,000, but now the cash invested is what? 120? This total equity then will be 630,000. What's the new partnership interest? Still 15%. What is 15% of 630,000?
94,500.
94.5? Okay. So now we know what we have to do, right? We have to debit cash for 120,000. We have to debit cash for 120,000. Credit capital for Madison for the 94.5. That doesn't equal, does it? How much help does the credit side need?
25,500.
25.5?
Yeah.
We don't divide that equally though, do we?
2080.
2080. Okay. So did you get a credit to capital for Maine for 20,400 and a capital for Frist for 5,100? Okay. That's just 80% and 20% of the amount needed to balance that JE. Cool? All right, let's look at the last example. What if the cash invested is 80,000? Okay. Well, let's take a look. Well, if the cash invested is at 80 grand, right? Then the total equity will be 590,000. What's the new partnership interest going to be?
15%.
Still 15%. What is 15% of 590,000?
88.5.
88.5? All right, well, we know we have to do. We have to credit the capital balance for Madison for 88.5. We have to debit cash for 8,000, right?
80,000.
Thank you for 80,000. Okay. So once we do that, try to just concentrate on the part of the JE that you can't see or that you can see. Okay. We credit Madison Capital for 88.5. We debit cash for 80,000. That doesn't balance, does it?
No.
The difference is what?
85.
8,500, which we're going to divide up 80%, 20% for Maine and Frist, respectively. Did you guys get that? Pretty much the same process as that bonus question. Okay? Take a look at these JEs again. This was a situation where, in essence, the old partners received a bonus because their capital accounts were increasing. This is a situation where, in essence, the new partner was receiving a bonus because the capital balances of the old partners was being debited or decreased. Cool? All right. Very nice. That's it for the homework, isn't it? Okay. All right. Do you care if we just dismiss class a little early? We're not going to dismiss class. I'm just kidding. I wouldn't do that to you. You guys paid for this, right? Okay, we are going to switch gears now. We are officially done with Chapter 12. I'll tell you all when your Connect assignment is after the cameras stop rolling. Remind me to do that, okay? You folks at home, taking it online, take a look at your calendar on D2L. We talked about sole proprietorships in Accounting 1, right? Chapter 12, which we just completed, we talked about partnerships. So what do you think we're going to talk about in Chapter 13? Corporations, you are correct. Okay? Corporations, all right? Let's talk about corporations. Now, I want you to understand with everything that we do in this chapter, there is a lot of legal stuff in regards to corporations. We are not lawyers. I am not a lawyer, okay? We are learning what we need to know as accountants in regards to accounting for corporations, okay? But this isn't a law class on all of the specific little things that you need to do and the limits and what you need to file when, okay? We're talking about accounting for corporations, all right? A corporation is an entity created by law. It is a separate legal entity, okay? It is like an artificial person, okay? Its existence is separate from the owners, and it has certain rights and privileges. It can sue, it can be sued. It is like an artificial person, a legal entity, all right? Now, The ownership can be privately held or publicly held. Let's come off of this for a moment. First of all, whenever I say the word corporation, what probably comes to mind is a huge company like PepsiCo or Garmin or Sprint, right? Please understand that the two of you could have incorporated your business, okay? What it means by a corporation is not that there's a lot of people. It just means that you have gone through the legal process of setting up your business as a separate legal entity. Are you with me? There's many more corporations of just a few people than the huge ones, okay? So keep that in mind, even though we might have a tendency in this chapter to think about the large corporations, okay, and the examples and stuff that we use. Now, back to the slides. The ownership can be privately held. What does that mean by privately held? That means that the owners have incorporated, they each have some shares of stock, but you cannot go purchase the stock unless they let you. You can't go to the New York Stock Exchange or the NASDAQ and buy that stock. Are you with me? And that would be similar to if you guys incorporated and you were privately held. We can't buy stock in that, okay? Daniel has stock, Michael has stock. That's a privately held corporation. Are you with me? Now there's a very, very large privately held corporation here in Kansas City. Do you know what that is? It's Hallmark. Okay? You can't go buy stock in Hallmark. The Hallmark stock is owned by the Hall family, and there's probably some other bigwigs that have some too. But you can't go buy that. That's a privately held corporation. Okay? The largest privately held company in the world, I believe, is in Kansas. Do you know who that is? The largest privately held corporation is in Kansas, down in Wichita, where I'm from. Koch Industries. Not Coca-Cola, but KOCH. You ever heard of KOCH, the Koch brothers? Yes, they're down there. No comments. They could be watching. Okay? So that is a privately held corporation. What is a publicly held corporation? A publicly held corporation is what we're more used to, like Sprint, Garmin, okay, PepsiCo, IBM, Apple. You can go buy stock in that company and thus become a shareholder or an owner of that company. Does anybody here own stock for a company? Not a mutual fund, but you actually own stock for a company? Anybody?
I think my stepmom has some stock in Cerner.
Cerner?
I think.
Okay. She has stock in Cerner. I used to have stock in PepsiCo. Okay. Now, if you wanted, Henry, you could be an owner of Cerner or PepsiCo. Well, let's not say Cerner. I'm pretty sure they're publicly listed. Yeah, they're publicly listed. Okay. But you could be an owner of Cerner or PepsiCo by the end of the day if you wanted to. You could just go buy stock. Okay. So when we say a publicly held corporation, the example is like Apple. You could go be an owner of Apple by the end of the day if you wanted. Okay? Cool? Now we're going to mainly focus on publicly held corporations, okay, in our discussion. Okay? We're going to mainly focus on publicly held. So I want you to think of perhaps me and my PepsiCo stock. All right? What are the advantages of incorporating your business? Well, you are a separate legal entity, and thus you have limited liability, correct? Your owners cannot be sued and have their personal assets taken, okay? There's that liability that you want to be limited, right? That's different than a partnership that had unlimited liability, and that really was a bummer, right? Corporations have limited liability. They also have transferable ownership rights. If I want to sell my PepsiCo stock, I can do that. Henry, if you want to go buy some PepsiCo stock, you can do that. You don't have to get special permission or anything, okay? Corporations have a continuous life. What does that mean? Well, if I'm a shareholder or stock owner of PepsiCo and I die, do you think PepsiCo is going to keep going on?
Yeah.
Yeah. They probably won't even send flowers to my funeral, will they? Okay? PepsiCo will probably be around longer than I will. Would you agree with that? It's sad, though, isn't it? Okay? But corporations have a continuous life. Now, there is a lack of mutual agency for stockholders. You can come off the slides. What does a lack of mutual agency mean? Well, let's say I own PepsiCo stock. I am an owner of PepsiCo. One of many, but I am an owner, right? Well, I can't go conduct business for PepsiCo. I can't go to Best Buy and say, hey, just put this all on PepsiCo's tab. I'm an owner. It's okay. Okay? Or I can't go down to the PepsiCo headquarters and walk around and, hey, what you guys working on? Is this the new Pepsi? That's cool and refreshing. They're going to go, who are you? And I'll say, it's okay. I'm Dave Krug. I'm an owner. I'm a stockholder. No, I am a stockholder and owner, but I can't go, I don't deal in the operations of the business. Does that make sense? I can't go conduct business. I can't ask for the trade secrets and all that sort of things. Okay? And believe me, I've tried. Okay, so you can't do it. I'm kidding. Okay, ease of capital accumulation. What do I mean by that? Well, let's contrast that with the Daniel and Michael partnership. Okay? Let's say you guys are a partnership. Let's say you want to raise $1 million. That's going to be pretty hard if you want to stay as a partnership, right? Unless one of you has a rich grandmother or something. Okay? The way you raise a lot of capital is you basically go public and you have an initial public offering and you sell stock and you raise millions and millions of dollars. You know some companies who've recently done this in the last few years. Who are those?
Facebook did that.
Facebook went public, right? Not too long ago, in somewhat recent future, Google did this, right? Years and years ago, Apple did this. And I wish when I was a little boy, instead of riding my bike around the neighborhood, I would have bought Apple stock, right? But they went public, okay? All right, so you have that way to accumulate large amounts of capital. Now, granted, your corporation has to be something that people want to buy, okay? So, questions?
So you haven't always been able to buy Apple stock?
Well, right when they very first started the company, usually what they do is they get, just like Facebook, they get the company going to get it to be an attractive product, and they finally say, hey, we're ready to have an initial public offering, and everybody's wanting to buy it, right? Facebook was around for a while before they went public, right? So the money that they were using was probably privately invested funds or something like that, okay? So, make sense? All right, good question. What are some disadvantages of being a corporation? Well, you have a lot of governmental regulation, a lot of forms you have to fill out, rules and regulations, get some fees you have to pay, and also the big one that's a huge disadvantage is the corporate taxation, the double taxation. Remember how PepsiCo has to pay taxes, right, to the government. So they pay taxes to the government. Now they have less money than they had before, and they pay me a dividend as a shareholder. Do I have to pay taxes on that dividend? Yes. So as an owner, that money has really been taxed twice, right? It's a bummer. All right. The corporate organization chart. I want you to understand that the stockholders have the ultimate control, okay? They can vote. They usually meet once a year. If I wanted to, I could go to the PepsiCo annual meeting and vote, okay? The stockholders elect a board of directors, and they are the ones who have the overall responsibility for managing the company. They hire the presidents and all the people underneath them. But please know that the stockholders are in ultimate control. Now, of course, with PepsiCo, I'm only one amongst many, 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 many shareholders. So it's not just me, but the stockholders as a whole are at the very top. You with me? All right. What are the rights of a common stockholder? Let's say I own stock in PepsiCo. Well, I have the right to vote at a stockholder meeting, okay? I can sell my stock. I don't have to ask permission. I can sell it. I can also purchase additional shares of stock. And we're going to talk about what's called the preemptive right of a shareholder. Let me give a real quick example of that, what the preemptive right of a shareholder is. Henry, let's say you own 1,000 shares of a company, and that company has a total of 100,000 shares of stock. You own 1% of that stock. Agreed? Because you have 1% of the total shares. Well, if that company decides to issue, say, 30,000 more shares, additional shares, You have the preemptive right of first refusal to purchase 1% of those shares if you want. Thus, if you do that, then you can maintain your percentage ownership. Does that make sense? So if you own 1% of the company and they issue additional shares, you have first right of refusal, the preemptive right to purchase that. And what that does is that prevents companies from just selling a bunch more stock to water down your percentage if they don't like you. You see what I'm saying? Okay? All right. The other rights of a common shareholder, they can elect to, or they can receive dividends if the company elects to pay. Now, the company does not have to pay dividends. Okay? Doesn't have to. But if they do, you have the right to receive those. And the right that you hope you never have to enjoy is if the company liquidates after they pay their creditors, you can go try to get some of those assets. Good luck with that, okay? But you do have that right, all right? Stock certificates. Each unit of ownership, you have a share of stock, okay? It's kind of like a nice fancy-dancy certificate that serves as proof that you have those shares. Have you guys ever looked at the title of your car? Kind of looks like that, doesn't it? It's just a little title. Okay, so kind of think of your title of your car as we have this discussion. Okay, but that's proof that you own the car, right? Now look what it says on the computer on the slide here. When the stock is sold, the stockholder signs a transfer agreement on the back of the stock certificate. Okay, that's kind of similar as with your car title, isn't it? Have you ever bought a used car and you've looked at the back of your, your little car title, and there's some transfers there, usually endorsed or validated by, what do they call those, a notary or whatever? Okay. Now some people own stock and they say, now wait a minute, I'm getting a little worried. I've never seen my certificates. Those are somewhere, I guarantee you. But there's a good chance maybe your broker has them or somebody's holding those for you in your name. Okay. So, all right. Now let's talk about some of the basics of common stock. Okay, this is a partial stockholders equity section of a balance sheet. And what this is saying is this is the common stock of a company. We'll talk about the par value here in a minute. But it says that they have been authorized to sell 250,000 shares. That's what the corporation's charter that was voted on gives them the permission, the authority to sell. They can sell 250,000 shares of stock. Now, they've only issued or sold 192,500 shares in 2016, and back in 2015, they only had 111,000. Okay.
So this isn't cumulative? Is this like they released those different numbers in different years, or does
well, that's a great question. Let's look at this.
When you add them up, you have over $300,000
yes,
in stock.
that's a great question. Let's answer that. Let's go back to 2015. They had 111,000 shares issued. Well, let's go to the next slide, actually. Authorized is what they have permission to sell. Issued is the amount that's actually been sold. So now let's answer your question. In 2015, they had 111,000 shares issued, which is where we get this 111,000. Okay? In 2016, listen carefully, they issued an additional 81,500 shares. They issued or sold another 81,500 shares. So now, at the end of 2016, they have 192,500 shares. Very good question. Okay? All right. Now, there's a term also called outstanding, which means the total number of shares that are currently held by the shareholders. Okay? So here it just says they've issued. In this example, the number of shares outstanding is also 192,500 for 2016. Okay? All right. Now let's talk about some things that seem kind of arbitrary, and you just got to kind of go with me on this, realizing that when we do some examples, it's going to make more sense. Okay? Stock, first of all, has a market price, or what we call a market value. This is the amount that a stock will sell for in the market. This changes not only every day, but every hour, if not every minute. You know, you hear about the stock prices go up and down for certain companies. That's the market price. Changes all the time. It's determined by the forces of supply and demand. Okay? Now, there's also something called the par value, assigned to a stock, written on the stock certificate. This is a total arbitrary amount. Now, there's some real legal wranglings in regards to this number that I don't even know all the implications of it, but I'm going to talk to you about how we use the par value of a stock. Okay? Hang with me if it seems a little fuzzy. Okay, we're going to talk about issuing or selling common stock. Let's talk about issuing par value stock, looking at the slides. Let's talk first of all about issuing par value stock. Let's say, now remember, we are looking from the perspective of the company or the corporation that is selling or issuing the stock. We are not looking from the perspective of the person buying the stock. Are you with me? So we are Matrix in this example. On September 1, Matrix Inc. issued or sold 100,000 shares of $2 par value stock, and they sold it for $25 per share. Let's record this transaction, okay? I think it's just easier to look at the JE and let me explain it to you, okay? How much cash came into Matrix? Well, we sold 100,000 shares and we sold it for $25 per share. So $2.5 million came in. You with me? So we debit cash for $2.5 million. We credit common stock. This is an equity account with a credit balance. We credit common stock for $200,000, which, listen, is 100,000 shares times the par value. You with me? The remainder goes to this account called additional paid in capital. Now, additional paid in capital, just like common stock, is also an equity account. It also has a credit balance. It also goes on the balance sheet. As a matter of fact, after we make this journal entry, let's look to see what that balance sheet looks like, at least partially. This is the Stockholders Equity section. Okay? It's going to say common stock, and usually you give some details on that. That equals $200,000. And the additional paid in capital is $2.3 million. Let's just concentrate on those two accounts in red right now. Are you with me? Everybody following that? Now, let me go back here, and let's say everything is the same, except the par value is not $2. Let's say it's $1. Everything else is the same, okay? But this time they issued 100,000 shares of $1 par value stock for $25 per share. Well, we would still debit cash for $2.5 million, but now we would credit common stock for 100,000. And the remainder of $2.4 million would go to this additional paid in capital. So for our purposes of accountants, the only thing that par value really does is determine how much gets credited to common stock versus the additional paid in capital account. Does that make sense? Okay.
Do you always want to label how much the par value is in the journal
Yeah,
entry?
you know, in your homework and stuff, you don't really have to, but you'll see in real life they usually do. Okay. All right. Now, do you see this? And of course, this would change too if the par value was just $1. This would be 100,000, and this would be 2.4 million. Okay? If the par value was $1. Okay? All right. See this guy right here on the balance sheet? This retained earnings? Retained earnings is $650,000. Okay? Retained earnings is the account that nobody can seem to ever remember what the heck it is. Okay? So on your next slide, I want you to put a big star by it. And that next slide should look like this. What is retained earnings? What is this? I'm going to say all of this, but in 2 weeks somebody's going to say, what is retained earnings? Okay, so really put a star by this and learn it. Listen to me, folks. Remember the capital account in sole proprietorships? Remember the capital accounts in partnerships? Retained earnings is a lot like the capital account, except for a corporation, we call it retained earnings. You with me? It has a credit balance. It's an equity account, okay? It keeps track of, looking at the slide, it keeps track of the cumulative profits that are retained, okay? It increases with net income and decreases with net losses, just like the capital account, right? It decreases with payments of dividends or owner distributions. Remember how the capital account goes down with withdrawals in a sole proprietorship? Well, it's the same way. Retained earnings goes down with owner withdrawals, but a lot of times we don't call them owner withdrawals with a corporation. What do we call it when the company distributes cash to the owners? Dividends. So looking at the slide, retained earnings is decreased by payments of dividends or owner withdrawals. Do you see how it's extremely similar to the capital account? But please know this. It's a very important account, and we'll talk about it a lot in this chapter, okay? Okay, you can also issue or sell stock at times, but you don't receive cash. You receive another asset. For example, you receive land. Let's look at an example of this. It's pretty similar. Let's say September 1, Matrix Inc. issued 100,000 shares of $2 par value stock for land valued at $2.5 million. Maybe there's a situation where there's a farmer south of the headquarters and they want that land. So they approach this farmer and they say, hey, we would like to purchase this land from you. And the farmer says, I'll tell you what, let's work out an arrangement. I'll give you the land, but you need to give me some stock. Okay? Well, let's look at it from the perspective of Matrix Inc. In that case, everything looks the same except we don't debit cash. We debit a different asset, land. You with me?
So that debit's always going to be an asset, basically.
For your purposes at this point, yes. Okay. I'm going to say yes. Okay? Where you are in your education, I'm going to say yes.
Okay.
Okay? All right, any questions on that? By the way, you might want to write this down. It's not in your slides. There are accounts that are titled additional paid-in capital, and I often abbreviate that APIC. Or there's another account called contributed capital in excess of par, CCIEP. Or sometimes they call it paid-in capital. These are all just different names for the same account. Are you with me? And it's basically after you credit the common stock for the number of shares sold times the par value, then you put the rest of the amount to balance the journal entry into one of these accounts. I have a tendency to favor this account right here, the account called additional paid-in capital, because I think it's most descriptive, and I usually just use the abbreviation APIC, and you're welcome to use that as well. Okay? But at other times in your book or in real life, you might see these other accounts. Please just know that they're the same thing. Cool? All right, we're almost done, but lastly, let's talk about no par value stock. No par value is stock that does not have a par value attached to it. Okay? For example, on April 1st, Leonard issued 50,000 shares of no par stock for cash of $450,000. In other words, the market price was $9 per share. How do we record that? We just debit cash for $450, credit common stock, no par value for $450. You with me? It's just that easy because this is no par value stock. All right? Okay, enough talking. Let me just give you your homework assignment, okay? Now, what I want you to do for your homework is there any questions I should ask? Okay. You know, read your textbook, I'm not going to tell you always to read your textbook, but you paid a lot of money for that. I would go ahead and read it if you have it. Okay, sometimes hearing it from a different perspective is good. If you're ever having trouble with any of this stuff, sometimes rewatching the lecture makes a big difference. Okay, but what I want you to do for homework is I want you to do this stock issuance handout. Okay. I also want you to do the following. I want you to do quick study 13.1 and exercise 13.1. And let me see, there's one more here. Just hold on one second. Talk amongst yourselves. Talk about what your favorite part of the lecture was. And let me get this other one. Okay. All right, I also want you to do quick study 13.2, quick study 13.3. If somebody's phone goes off, he has to bring cookies for the whole class, don't you? No raisins in those cookies either. Nobody wants dried fruit in their cookies, but you owe cookies for the whole class, okay? All right, so let's take a look at the screen, and then I'll let you go. I want you to do quick study 13.1, 13.2, and 13.3, exercise 13.1, and also this chapter 13 stock issuance handout. All right, guys? Hey, have a great day, and we shall see you later.